Hello investors, welcome back to my YouTube channel. First of all, a big thank you to all of you for showing so much love for my previous video, where I revealed top 5 hidden stocks which can compound your wealth. If you haven't watched that video yet, you are missing a lot. Links in the description, go watch it now. This video is part 2 of my recent video. In this video, I am revealing another 5 stocks which are not only fundamentally strong, but also a low float, lesser popular in social media, and have generated decent returns over the past year. Just a small reminder, consider this video only for educational purpose. Don't consider this as buy or sell recommendation. So let's see, one by one. First company on the list is Cigniti Technologies Limited. Every app you use, every banking transaction, every AI system running in the background, before it reaches you, it must be tested, validated, and secured. And that's exactly where Cigniti operates. But what does Cigniti actually do? Cigniti Technologies is a pure-play AI-led digital assurance and quality engineering company. In simple words, they make sure enterprise software doesn't fail. Their services include digital assurance, AI-led testing, automation, performance security, and non-functional testing. According to the company's own disclosure, the digital assurance services market is valued at over $23 billion and is growing at around 2.5% annually. And here's an important detail most people miss. The testing services market is 4 times larger than the testing products market. That's a structural tailwind. Cigniti Technologies was acquired by Coforge and has been integrated into its broader digital services ecosystem. Cigniti now isn't just a niche player, it's the trusted assurance partner of a major IT services firm that sells digital transformation, cloud, and AI solutions. Industry tailwind, why demand is not going away. With AI and Gen AI adoption, software systems are becoming more complex, more interconnected, more risky if they fail. Cigniti has built IP-led platforms, including Blue Swan, focused specifically on AI assurance and automation. This puts them directly in the path of long-term enterprise demand. Now let's talk about financial performance. Compounded revenue growth of last 5 years stands at 18%. It grows from 872 crores in FY20 to 2014 crores in FY25. For the same period, consolidated profit growth is 13%. VAT Y20 net profit was 122 crores and it roses to 200 crores in FY25. Note something important here, profits are growing faster than revenues from last 2 years. That's operating leverage kicking in. Cigniti balance sheet is very much clean. Debt to equity is just 0.02 and PEG ratio is 0.51, which indicates its growth is under to fairly valued. Management and corporate governance. This is where long-term investors sleep peacefully. All related party transactions are in the ordinary course of business. Auditors have issued unqualified opinions. No aggressive accounting. No governance red flags. So why can this be a multi-bagger? Let's connect the dots. First, it operates in a $23 billion digital assurance market. Second, direct beneficiary of AI and enterprise digitization. Third, zero net debt and strong cash reserves. Fourth, asset-light scalable business model. 5. Clean corporate governance. And last one is strategic importance enhanced post-integration with Coforge. Second company on the list is R Systems International Limited. It is a digital product engineering company backed by Blackstone, operating at the heart of Gen AI, cloud and data engineering. Let's start with what R Systems actually does, because this is where most people get confused. R Systems is not a traditional IT service company, it is a digital product engineering company. In simple terms, they help global companies build, scale, modernize and run digital products. Their work spans across digital product engineering, cloud and DevOps, data analytics and AI, generative AI solutions, automation, embedded engineering, quality engineering, and enterprise software implementation. R Systems has been operating for over 30 years since 1993. They operate across 17 countries with 27 offices and 18 global delivery centers. And here's an important number most investors overlook. More than 85% of their business comes from repeat clients. That alone tells you this is not a one-time vendor. This is a company deeply embedded in client operations. Now let's talk about financial numbers. Last 5 years financials of R Systems are pretty strong. Revenue CAGR is standing at 17% and profit CAGR at 18%. Operating profit margin is grown from 13% to 15%. ROE stands at 25% and ROCE is around 20%. Despite global tech slowdowns, earnings remain stable and predictable. This shows how management efficiently works. Best part about management is they didn't dilute their equity in last 10 years. They have invested in Gen AI Innovation Labs, set up a joint research center with IIT Delhi for applied AI and Gen AI, acquired Velotio Technologies in July 2023 to strengthen product engineering capabilities. Next company on the list is Macfos Limited. This is a micro-cap company having less than 1000 crore market cap, but trust me, fundamentals of this company is very much strong. Some of the biggest wealth creators actually come from simple businesses with strong branding, asset-light models and scalable demand. Today's company fits exactly that description. This is Macfos Limited, popularly known through its flagship brand Robo. What does Macfos Limited do? Macfos Limited operates in the electronics components and engineering product space with a portfolio of over 12,000 to 24,000 SKUs. Its offerings include SEC electronic components for prototypes and R&D, robotics parts and kits, SEC IoT parts and modules, 3D printing and prototyping services, engineering assembly services, battery assembly. Macfos Limited operates in the consumer electronics and robotics components ecosystem. The company is primarily engaged in trading and distribution of electronic components, robotics kits, IoT products, sensors, microcontrollers, DIY electronics and educational products. Macfos sells directly to students, engineers, hobbyists, educational institutions, startups, OEMs. The company operates under its well-known brand Robo, which has strong recall among India's maker and robotics community. Macfos follows an asset-light trading and brand-led model. Key strengths: strong in-house brand Robo, online-first distribution, wide SKU portfolio, direct customer reach and fast inventory rotation. Now let's move to the most important part, the financial numbers. If we look at the consolidated quarterly data reported on screener, one thing becomes very clear. Macfos has shown a strong upward trend in both revenues and profits over the last 2 years. Let me quickly walk you through the journey. In FY21, company reported 80 crore of revenue and 7 crore of net profit, with operating profit margin of 11%. In FY25, that number rose to 255 crore in revenue and 18 crore of net profit, with 10% operating profit margin. That's nearly a 300% jump in revenue and 250% jump in net profit. Compounded annual sales growth is standing at 76% for last 5 years, and compounded profit growth is at 120%. Return on equity is at 36% and ROCE is at 42%. These are very strong return ratios, and they show that the company is generating high profits relative to the capital it uses. PEG ratio and debt to equity is less than 1%. This clearly indicates low overall leverage. Now let's talk something. Most investors ignore management quality and corporate governance. Macfos Limited is led by Atul Dumbre, who serves as the chairman and managing director. Promoters currently hold around 69% stake in the company. This level of ownership indicates strong promoter skin in the game. If you look closely to the shareholding pattern, 7.61% hold by DIIs, especially Sage One Flagship Fund, a reputed investment firm. This is a huge thing for a microcap company. These are the reasons why Macfos is a multi-bagger. Risks you must not ignore. Valuation is on the higher side, with PE around 42. Free cash flow is currently negative, indicating working capital pressure. The company does not pay dividends. Fourth company on the list is Precision Wires Limited. Their other small caps failed to deliver even positive returns in last 3 years. This stock has given mind-boggling 46% CAGR in last 3 years. Sadly, hardly anyone knows such companies. Precision Wires India Limited is a leading manufacturer of enameled copper winding wires in India. These copper winding wires are critical components for electrical machines like motors, generators, transformers and fans. The company also makes continuously transposed conductors and paper, mica insulated copper conductors used across electrical and electronic industries. Precision Wires is reportedly the largest producer of winding wires in South Asia, a position that gives it strong competitive leverage. Industry context: why this matters. Precision Wires is part of the electrical components and industrial products ecosystem, especially power generation and distribution, consumer electrical equipment, industrial machinery, automotive electrical components, and one renewable energy equipment. These sectors are steadily growing, and winding wires are a critical upstream input. This gives precision wires exposure to structural demand rather than one-off cyclical sales. Annual revenue growth for last 5 years stands 21% and profit growth stands at 23%. Despite having low operating profit margin, generally 5 to 6%, company generated profit consistently. They distributed dividend each year since 2014, which shows profits are real and there are no accounting manipulation has been done. Here are the important profitability and efficiency ratios. Return on equity is 16.63%. ROE has improved over time from 13% in March 21 to 16.63% in March 25. Last 5 years average ROCE is standing at 25%. Debt to equity is 0.19 as on date, indicating very low leverage and a clean balance sheet. Company's management has been transparent with quarterly earnings and expansion updates shared publicly through regulatory filings. Promoter holding stands at around 57.48%, showing significant promoter skin in the game. Let's distill the case clearly. Strong market leadership, largest winding wire maker in South Asia with specialized products, consistent revenue and earnings growth. High return ratios and low leverage supports financial stability. Capex for expansion. Strategic industry exposure. These are the hallmarks of companies that can compound earnings over time, even though the business fundamentals are strong. Valuation appears rich on PE and PB. Free cash flow has been negative recently due to working capital. Change in copper prices can impact margins. Now, last company on the list is Pricol Limited. Pricol Limited is a leading automotive components manufacturer headquartered in Coimbatore, Tamil Nadu. The company is best known for manufacturing instrument clusters, automotive switches, other precision components for two-wheeler and four-wheeler OEMs. Pricol is the second largest instrument cluster manufacturer globally by volume, with 55-60% market share domestically and nearly 65% market share in the two-wheeler segment. Pricol operates in the auto ancillary sector, supplying products critical to fuels, internal combustion and EV vehicles, passenger vehicles, two-wheelers and commercial vehicles, replacement and aftermarket segments. This sector is tied to broader auto industry growth, electrification trends, and vehicle penetration in India and globally. Let's look at how Pricol's financials have performed over time. Last 5 years, revenue CAGR stands at 17% and compounded profit growth stands at 30%. In FY21, company reported 1400 crore of revenue with 42 crore net profit, and in FY25, that numbers rose to nearly 2700 crore with 167 crore net profit. These are very strong numbers. Cash flow from operations are pretty strong, which shows profits are real. 5 years ROE standing at 15% and ROCE is at 20%. PEG ratio is 0.91. Debt to equity is just 0.115. There is just 169 crore of debt on balance sheet. Interest coverage ratio is around 14%. Low leverage and strong interest coverage show a well-managed balance sheet. If you look at shareholding pattern, promoter holding is just 38.51%. But best part is promoters haven't diluted their equity in last 5 years, which shows integrity. Large chunk of holding is held by FIIs and DIIs, around 31%. That shows big investors are very confident about company's growth. Pricol announced plans to invest 500 to 600 crore over the next 2 years, with about 250 to 300 crore planned for the current year. Focused on capacity expansion in switches, SPMs and disc brakes and new facilities. This capex cycle is tied to higher capacity utilization, new business wins from OEMs like Ather, Hanan, Autoliv, Schneider. Advanced discussions with major OEMs such as Hero, Honda, Bajaj and Tata Motors. Some risks to watch. Even with strong fundamentals, valuation is on the higher side. Automotive cycles can be volatile, raw material and supply constraint. Pricol Limited is a well-positioned auto ancillary stock with consistent financial growth, strong profitability metrics, healthy cash flows, strategic capex plans, structural industry exposure. These make it a compelling long-term story for investors and a potential candidate for multi-bagger returns over time. Well, that's all from my side. Carefully track this business. They have immense potential to grow in future. Which stock is your favorite? Please tell me in comment section. If you like this video, please hit that like button. It boosts my confidence. Please subscribe for more such valuable content. Share with your friends for better reach. Thank you.